So thanks a lot, Rob, for having me here. And I understand that I had a little bit more than the 25 minutes that you announced in order to set the status and also come with some forecasting on the energy complex. I think it's pretty important when we actually are here to say that, as you all know, energy is a huge part of the cost in a cement production. I also will say that it's becoming even more important to focus on this as we are seeing volatility increasing, and it has really been increasing dramatically last year, which I'm going to be talking you through. The reason why I'm actually standing here is that I have been in the markets for about soon 40 years. In this respect, this is why you see the hair is getting gray. I wake up every night and sleep like a baby. I wake up every night and I start crying when the market is not going right. But all over, I've been through quite a bit of companies. I've been both sitting on the buying side of energy, I've been on the producing side of energy, and for the last years I have actually gone independent. I have my own trading company, so I do actually trade what I say. I trade the currencies, I trade the oil, I've been trading some part in the carbon market, etc., etc. So I actually try to do what I think will happen as well. I also have been doing quite a lot lately in tailor-making for companies, very specific forecasting and going through the company's fuel exposure, petcoke, coal, looking into what are the impact on some of the other parts. Some is still doing things in oil. And of course, for the last 1 year, suddenly carbon has come back to the market. So also having very focused eyes on the carbon part. And of course, carbon, if you had 1 million tons of a carbon exposure, it has suddenly become 15 million euros more expensive than it was last year in this respect. Then we're also trying to help people with the risk management, sitting together with both the purchasing and the selling departments, and actually go through strategies, and most important, not just delivering reports, but actually giving a implementation so that it works when it's in there. That's some of the things that I like to get done. So, what are we going to talk about? First, I'm going to give you an overview. Let's see if this works. Yeah. So I'm going to set the stage a little bit, because we have, whenever we talk energy, we have to start with the big picture. And for the big picture, we need to look a little bit on the big currencies. I will this year also look a little bit into the dollar against the Turkish lira, because that has really been some tremendous swings we have seen in the Turkish currency. I will go through the oil. Oil is still the mother of all the energy complex, so to say. So we need to know what oil is doing in order to know what coal is doing, in order to know what the rest is doing. I will be talking about the carbon market very shortly, because that has really been the hottest market that we have seen this year. And then I'm going to go through key points for the coal and the petcoke markets. And I will actually refer quite a bit to the things that we are doing in the CEM review, which is given out by CemFuels, which is my biggest clients, where I'm making this about 8 times a year. The CEM review, you can come afterwards if you want to have a closer look. And in our annual conference, we have last year in Prague in October, we came with quite a lot of forecast for oil, coal, petcoke. And if things are happening, you can say really big things are happening, we of course come out with revisions of those, and that is actually just taking place. So today you are actually going to see the revisions of the things that we had in our conference in Prague last year. Later on you will see a little bit of commercial. It will be in Krakow in October next year. That was the commercial setting hat on here. When we have gone through that, there will be a little time for questions. But overall, you can say many of the things that I will be talking, and some of the charts most of the charts that you'll be seeing here are actually coming from CEM Review. I'm also doing a little monthly report on energy in the cement review in that respect, but that's not to do with the big one here. So what are CEM Review actually doing? We are not saying or pretending at all that we know all the fundamentals in all countries, what goes on in every single refinery. Actually, that's more or less important with the resources and the setup. But what we do believe is that you see fundamentals reflected in the prices. They should be, normally, of course. So what I'm doing is really to try to analyze the prices, what have they been, and what are the markets doing, and what are the, you can say, the alignment of the markets and the different complex connections between the oil market, the coal market, etc., etc. All this is very often can be done very, very complicated, or it can be done relatively simple. I try to keep it simple. Simple often means having a graph that shows the things, and what we do for the readers is then to try to say, we have a market focus point, what is it that you need to know, and then we will have a forecast saying, we are here, this is where we think it will go until our next edition, and if it comes to this level, be careful, this could be the high level. If it falls to this level, we see it falling to the next and the next. So that you all the time, you know, where are you, what is the upside, and what is the downside levels that you should be looking at. We have also come out with, especially when we talk about the petcoke and the coal, this is not the forecasting or anything at the moment, but we have been doing a lot to say how much are the discount for petcoke compared to coal when you analyze it at the calorifical value, so to say. And I think this is a development when we talk about alternative fuels. Petcoke may have been, let's say, the alternative fuels 30, 25 years ago, and this is now becoming more and more commoditized. I think that the other alternative fuels, which I also know that Andy will be talking about later today, could be ready to take the next step into a more kind of a commoditized market. Not all of the alternative fuels, but some of them may be very close. And then I have no doubt we will again say what is the cal value, the calorific value for this and this fuel, and we will calculate discounts maybe to coal, maybe to petcoke, etc., etc. And in fact, people will be trading, or let's say buying or selling it, compared to how big a discount we have. But this I will come back to later. One of the most important things, and we had this in a way last year as well, but it has not been less important, is to know that the energy complex is tied together. You cannot just sit and set the price of petcoke without knowing what happens in the coal market, you know that, or what happens in the oil market. If you see here, the top graph we have here is actually the price of coal. This is the South African coal, and here you have the two main oil grades, which is traded. That's the Brent oil, that's the red one, and then we have the American, the WTI, on the gray one. And if you see the tendency, this is back from 2016, and since 2016 we actually had a long, quite prolonged uptrend in all markets. This is where oil was down at $28, and then we had a kind of a nice and long rally upwards, and you saw exactly the same thing happen more or less in the coal market. From time to time you can have things. Here I think there was some strikes and other things coming in, and some hurricanes in Australia that came in on that one. But again, you see the trends, and then you see here oil, which was just a few days after our conference in October, suddenly starts to collapsing, and I will come back to these as well. And you see the same thing happening in the coal. We saw oil collapsing just before December, down to 50, and coming back up now. And you see the same reversal happening in the coal market. And then when you go from oil to coal, you then go from the coal into the petcoke. Again, the black one, and here I'm back all the way back to 2004, I think, yeah. So the black one is the coal price, and here you have 2016 where you see the upturn, and you see the petcoke, and there are two types of petcoke I look at. The high sulfur 6.5, which is the red one, and that is the most traded commodity for the petcoke. And you see exactly how they are following each other in this respect. So you can't determine the price of the petcoke without having gone through the whole energy complex. In CemReview as well, what we try to do is, again, we will try every time to put in a kind of a forecast. So we will always say, where are we and what is the forecast for the different commodities. So last time we looked at Brent oil, it was at 61 where we were writing the report. We thought it would go up to 63, and with a top level of around 68, and at the moment it's trading at 66.50. So luckily for that one. But that, and we also do the same when we talk about the, can you actually see it here? When we talk about the petcoke, we try to say where are the current prices for the petcoke, what do we think they will go to, and what is the low and the high for the levels. So that as a reader, you will have the opportunity to actually make your risk decisions on this one. Now, last year we had a nice reward for taking care of promoting the alternative fuels, so we were very proud of that. So we will of course just show one updated graph, and I know a lot of people will be coming into this, so I'm not going into details on the alternative fuels this year. But this is from CemBureau, and we actually now, in the Cem review, have started to take in news and updates on some part of alternative fuels as well. And as the market will start to progress, we will also have this in just the way that we took petcoke in beside coal and oil. So 44% is now the level that the thermal energy from alternative fuels in the CemBureau world is having. And that actually is steadying out a little bit around the 11.5 million tons. And this is the 2016 numbers, which CemBureau is allowed to update. And I'm sure some of you will have some more recent numbers. So I'm not really going to spend a lot of time on this. And it equals roughly 18.5 million tons of saved carbon emissions, which of course we should be proud of in the industry. Especially now that suddenly, let's say the value of this, let's say when I spoke last year, we were having a value, I think, around 8 euros per ton. So we can say that was saved for about 840 million. Now suddenly you can multiply this by 20. So now it's quite a different number. Now we talk about saving of about 350 million euros worth. So price really do matter on the bottom line as well. There's nothing to really go through here. So let's get into the forecasting now, and let's look a little bit on the FX and the energy markets. This is a very, very long-term chart. This actually goes back all the way back to 1999, where we had some very dramatic moves in the dollar. We are back here in 2005, and we saw that the euro has been going up, just like we had seen the euro has been going up here. Then suddenly there's appeared a top, and we have actually seen exactly the same pattern taking place at the moment. We believe that what you have seen here is a kind of a cyclical trend in the euro and the dollar. And the forecasting that we are having is that for the moment we are trapped between 112, 116. But in reality, I will be looking for a 125, even 130, when some of the trade war fears have gone over. The US, which started to actually increase interest rate quite dramatically, the Fed, that was the reason for why suddenly the euro started to come down. Europe also have its own problems at the moment. There are some of the political turmoil in Italy, political turmoil in France, and of course we have the Brexit weighing on the EU as such as well. When these things are over, and I think they will be over, I think we can see the euro slowly again progressing up towards the 125 level and potentially going higher. But that will take some time. If we zoom in a little bit, for those of you who may not be familiar with these kind of red and green things, you may say, what is this? A red one means that the rate started here this is a monthly chart. So this is actually where the month started, and this is where the month ended. In a green one, this is where the month started, and this is where the month ended. So green means that the month was up, and red means that the month were down. And those you will normally be looking into both on a daily level, and you will also have them on a weekly level. If you look a little bit on the picture over here on what we think of the dollar, here you have a very, very big support. Support means where it can't really go below at 112, and you have a very, very big resistance at the moment around 118 or even here. We are now in a small uptrend channel, and I do believe that we are going to see the euro against the dollar trading roughly between the 113, 116 over the next period here. But it very much depends on the trade war talks with the US, China, and also what will happen with Iran. Iran is now becoming more and more on the radar for the US administration, and we have seen some rather warlike rhetorics about regime change and things like that taking place. But overall, dollar stable 112, 116. Should war suddenly break out one way or another, a quick dip down to around 110, but I really don't think that was going to become much more than that. The Turkish lira, people have actually been asking us to look a little bit into this. I will first start over here on the right side. This is where you see a long term from 2012. The Turkish lira was trading about 2.5 Turkish lira to the dollar, and it was in a nice trend following the difference in inflation, more or less, where the Turkish lira was devaluing. We then saw a move, and then when we had the attempted coup, we really saw an explosion in the rate. And we saw it more or less having a 80% devaluation. It went literally from 3.5 and it topped out at 7.5. Then the Turkish central bank took in some measures, higher interest rate, other things were done, and we have now seen the Turkish lira having renewed or regained some part, not strength, but at least not as weak as it used to be. I believe that we are going to see it in a kind of a range where the 525, the 520, 530, you can have a wide range in this one, is going to be a kind of the lowest that the dollar will fall against the Turkish lira. And I think we are slowly going to see it coming back into an uptrend channel towards the 6. But right on at the moment, the 520 to 570 seems to be a good 10% trading range that the Turkish central bank is okay with and that people seems to be accepting. However, as much as it was very overbought up here, it is now becoming oversold. So there's an indicator here that we may actually start seeing a move back up. This morning when I was checking it, it was 530 as well. So it has come back to this level. So Turkish lira, I think we are at the strong point of the Turkish lira and could actually see some weakness coming back to it. Not in the way that we have seen it trading like this, but slowly but steady, maybe coming into the normal devaluation trend again. Now let's go a little bit into the oil. The oil, again, you have here a weekly chart, a monthly chart on this side. So this is actually back from 2016. 2016 is when OPEC made their first agreement of cutting. So this is an extremely important level. We then saw a trend that took place for almost 2 years. In October, and a lot of my forecasting was actually based where we saw the market in October, and I have now revised those things based on the simple fact that, well, we did not break $100, which a lot of forecasters were thinking about. And I want you to see over here, this is the weekly. We had the big trend, the one here. That is the yellow that you are seeing here as well. We then saw a rally where the US were boycotting Iran, saying Iran couldn't sell anymore. Venezuelan oil has been going out of the market super fast. They are only producing half of what they used to do. And we had a lot of geopolitical tensions coming up. But in October, everybody was seeing that the oil was actually breaking above 80. 80 is a very important point in the oil market at the moment, so do keep that in mind. When it broke 80, we had Goldman Sachs and other ones out calling for $120. I was taken in a little bit as well. I thought we would see a market going from 80 to 100, and it was really approaching. Then suddenly we realized there was extra American shale oil being produced. The Americans did not take away all the Iranians' possibility to export. They gave waivers to like India, China, South American states. And suddenly the market found itself that the trade war was becoming real. So suddenly people were really afraid of the demand from China and from Far East, if that should be falling as well. We saw worse production numbers of Europe. So suddenly the demand of oil started to collapse a bit. And it was a true collapse. This was the fastest fall that we have seen in the oil market, actually since it last time fell down to 29. So we fell from 87 down to below 50 in December, where the OPEC then went together again. Because don't forget, Saudi Arabia and some of the other states are really depending on these oil revenues to be around a 60 to 80 level in order for their budget to run around. So OPEC and Russia made a new agreement and they started to stabilize the market. We were then forecasting that we would see it coming back to around 63, and if it would go above 63, we probably are going to see it trying to get back into the long-term trend, this one here. And we are this morning trading roughly around 66.5 at the moment. So we are actually coming backwards up. The expected forecast, and this is is 60 to 80. As long as we are below 80, we are not going to see a new rally up towards the 100, but if the 80 starts to be broken, and maybe it's 78 or so, 78, 82, if that level is going to be seen, I'm starting getting bullish, and you will see that on coal and petcoke as well. And for the moment, I think we have the 60 level to the 80 level as the range going forward in 2019. In reality, to watch the oil market is in reality to see what is OPEC doing. You don't have to read all the numbers here, but they actually decided to reduce the output about 1.2 million tons, and Saudi Arabia was out to say, we will do more if the market don't behave. The problem from Saudi Arabia is they used to be the absolute biggest producer, but now the US is producing more than Saudi Arabia actually. So sometimes we can say the Americans take the advantage of OPEC cutting their production, prices comes up, and the US puts more out. Now the US is also reaching a kind of a level where there are bottlenecks of getting the shale production out to the refineries, and also it's getting harder and harder to find more skilled work, etc., to just keep producing. The indicator from the US production is really the rig count in the US. So every week they are counting how many rigs are doing oil and gas in the US, and as you see, it has been going up, and it took a little bit more up here in September, October, when we had the high prices, and now you're seeing it has been stabilizing up here. So now we may say, okay, so are they now near their production top? Not really, because this is the picture that we have for the possibility for US count, and we are here at the moment. But if you look back and you see where they were in 2014, 2013, there would actually be potential for another 40 to 50% capacity of rigs. But a lot of these rigs at that time, I have heard, were not very efficient. So of course you make one that counts for the same production of rig. But we are definitely not at the top of where the US could be at the moment. So now I'll just take one water. This drop could almost have been the cartoon for your article in your magazine where you were writing about the carbon market and the carbon margin for cement producers. And I think in this respect we can say that the EU has of course been wanting to lead the way, but having worked in CemFuels, I also know how we can say how big and tough a burden it can be for companies. When the prices were down at 5 to 6 euros, it was like everybody had more or less forgotten about the carbon market. We in CemReview actually said when it broke above 7 there was a potential, and I remember here last year as well, we said we could easily see 15 to 20 euros, and indeed it became actually the hottest market that we had seen. It went to 26, and I will now zoom in a little bit on this. The carbon market back in 2010, it topped out around the 30 euro. We then saw like a virtual collapse of it, and since 2013 until 2016 it was trading between 3 to 5 to 6 euros, and let's be honest, it was almost forgotten. It was a kind of an appendix in the bookkeeping. 2016, where we had the OPEC meetings, prices of oil and everything started to go up, nothing really happened in a year, and then suddenly attention started to come in. The EU made a whole revision of the carbon market. They really took away some of the oversupply that there was starting in 2020 when we will have the new phase, the phase 4 coming in. In this respect, people also started to look at where are actually impact coming from the carbon market. It needs to go up around 2030, and the higher the coal market and the higher the gas prices goes up, even more must the carbon market come up. And one of the things that we wrote in CemReview, and we really said over and over on conferences, was you can buy something that you know your company will need until 2030 under the current rules, where everybody talks about 30, 40, 50 euro, and you could actually buy it for less than 5 to 7 euros. And you could bank it. So you could take the carbon the EUAs that you had, put them in the bank, and they could actually be there for the next 15 years. A very cheap option. So when it broke above here, and there were some market signals, very technical signals, etc., that we went above 7.5 and above 10, the breaking of 10 euros really made people focusing on this. And we have since then been moving in a trend that has about 5 to 6 euros in spread, as you see here. And we have been up reaching the 26 level, and now we have just been down. It was trading yesterday and this morning at 20.5. The 20.5 is just here where you have the red arrow. So I think, yes, we are a little bit on the low point. The forecasting for the EUAs is it will be very volatile. I think we will be inside this channel. Maybe the big support point where the lowest is this 18 euro, but I think steady, very steady, we are going to go upwards towards the 30 level as the next and beyond. Don't forget, a lot of NGOs and other ones are calling for 50 and above. And the carbon price is not only what you need to be in compliance, the carbon price goes into your power price because the power producers need to buy the carbon and they simply add it on to the power price as well. So this is a huge effect. And therefore, I've also started with companies when we come out and we do the forecasting for fuel and other ones to sit with the purchasing department and the ones who take care of the EUAs and really take some hedging strategies into this. Again, if you had 1 million tons in exposure, here it was 5 million, now it's 26 million euros. You have to sell some cement at least to cover that one if you were caught short. So again, forecast towards the 30 in a trading range coming up like that. 18, if it breaks 18, we have a new situation. Then something must have happened that I don't know, at least for today. This is just to say here, this is a more simple way of looking at it. The long-term trend is up here. Again, this is the 18 range. But this is a forecast from one of the people I talk a lot to. I used to work for TDF Suez, now called Engie, and they do a lot of good analysis as well. And what they have said is, there are, here you can actually see, this is the need in the market, so this is the demand, and then you have the whole market. Here we had an oversupply, but as we are going more and more into 2020, the next phase, there's actually going to be a deficit in the whole system, which means that people actually do have to come out and buy things if they don't have them already. And I think this is what people have been positioning themselves. So actually, when the market was above the black line, price were low, and now we are seeing that the market will be in a deficit. So let's get into the fuel markets now. Coal. This is a slide I have been borrowing from IEA, from our conference, where they just said you need to look at the very long-term trend. So this is a 20-year chart saying what is actually the demand in million tons of coal. So we have seen a steady trend around 4.5% per year, up to a kind of a 2012, 2013, and then as the IEA say, we see now a stagnation. But they don't see a fall. In Europe, we talk a lot about, and I'll come into that, a lot about that we now stop using coal, etc., etc. But I think we have to look at the very big picture. If you look at the world, if you look at the world's demand for coal, well, inside the red area, you see this is the European Union, and we are of course talking about that we want to reduce our coal footprint of the world. But again, overall, the real total demand doesn't really change. And if you roughly take the European Union, I think I calculated for Denmark, if Denmark started to stop using coal, we could save about 4, maybe 5 hours of Chinese production, consumption in that respect. And Europe, I think, is calculating for India and China together, we could save about 14 days of consumption in those two countries. So yes, it's right, we do make nice, you can say, clean air here, but on the global scale, coal is not going to go away in the near-term future. So this is important to know that the demand for coal is still there when we think about pricing, which I come into now. So don't only look at now Germany will phase out coal, coal should be cheap. No, coal is still globally very, very much in demand. And so it will be at least until 2050 based on the IEA forecast. This is just the EU where we have seen some of the parts, but again, I do say, do not let the the lower demand from Europe put you into a thinking that coal maybe just become very cheap. That is not going to be the case. So everything was actually in October moving one way. The energy market, you saw oil, coal, other things were just moving ahead, and then suddenly this was suddenly reality. And I was a little bit annoyed that these two guys couldn't have done it at least 2 weeks before our conference, because then I wouldn't have been standing forecasting going things upwards, and then 2 weeks after seeing one of the biggest and fastest collapse in the market in a long time. So we'll have to talk more of them when we go to Krakow. So China is always one of the big elements whenever you talk coal. So trade war, Brexit, major economies taking a little bit of a breather, and overall impact from the geopolitical scene is of course the big thing. China, I talked about this last in Berlin, have put in a maximum price of coal, and I show you a chart. That means that they didn't want the coal to come above 111 in China. They were now succeeding with this. India, the other big consumer, has improved their production, but again, their consumption in the power sector has been rising even more. And again, in Europe, high carbon prices are of course hitting into some of the coal demand as well. This was a little bit the background. The black writing was what we had at our CEM conference, where we said, well, oil will be breaking 80. We saw at that time a potential for a $70 to $100 range, which would be lifting the whole energy complex in 2019. That was not happening, because we saw, and I am now saying I see, as I said before, coal in a $60 to $80 range over at least the next 3 months, which will be reflected in all the forecasts. Roughly, my forecast will come down to about 20% lower, not for carbon, but for the energy complex on its own. Again, China is the main factor, and prices have in coal indeed come into the Chinese preferred ranges. I show you that as well. But China has also been doing import restrictions, and this is of course the thing. There is a lot of political news that can hit you in these markets, and China actually putting in place that you can't import coal to different ports will make that suddenly the supply will be a little bit bigger in the Australia and Indonesia, and they can't get rid of them as they normally are doing. In Europe, not a lot to say there. We had a milder than expected winter, and gas prices have actually fallen as well, and that means that there's a little bit lower coal demand here, and this I have already said. Yeah, China. This is the price of the so-called 5,500 kilocal in China for a delivery of 45 days. This one has been moving very dramatically up and down, and then China decided in 2017 to say we will have a maximum rate, we will have a minimum rate, and we actually like the price to be in between the two green ones. They did it here because they actually wanted to put a top there. But as you saw, this was done when all the markets were going up. Remember, back from 2016, we saw a rise. So we really saw that the Chinese prices were going way, way, way above. They just said goodbye to the top. And then in, when was that? That was in April last year. They said now we had enough. No one, when the price was actually threatening to go even higher, China said we now introduce an absolute maximum price of 750 Chinese renminbi. That hit the market. So you saw a total collapse in the Chinese market itself, because they really said this is the top and we want you to put the price down here. This also happened for a few months where we saw the collapse in prices, and this was also seen in the global coal prices a little bit. And since then we then went above again, but never above the maximum rate. And there has been a kind of a steady trend. And now the Chinese are finally having their coal where they want them. This is also why I think the coal market has stopped falling. It was falling all the time because the Chinese were pushing and pushing for the price to come down, which of course is reflected through the system. So in the overall coal market, there was a technical picture saying that if coal went much above this level of about $95, we could actually see coal moving all the way up to 125. This is what we tried to forecast in October, but now the rally has been postponed, and instead we are actually testing the downside. And at the moment, we are just trading around here, so on this green line, which also seems to be a kind of a support zone. So I think coal is going to come back and go to a more consolidated level over the next month. This is again the big chart, and this is now the first forecast. If you look at coal, the API 2, which is the European coal that we look at, we had a forecast of 90 to 120. This was our forecast for 2019 with an average of 110. Again, this was too optimistic and it has been revised down, and the new revision is really a range from 70 to 100. This is there. So in this range we see it. And you may say, that's quite a big range. Yes, but the yellow one is actually the trading range that we saw last year, right? So it is volatile. 20-25% is not that much of a trading range. But average around 85, so higher than where we are today. The API 2 this morning was traded at 75, so this is actually more or less where we are, where we also were on Monday when I updated this one. And again, we have been in a long-term uptrend. It broke out just like you saw on the oil market, and now I think we are catching up on a stabilizing factor, and just like oil, we are going to come back up here. And I do still believe we could see a range of 85. For the long-term contract, if you are looking a little bit more on the longer term for the oil, again, we have revised our forecast. We are here trading 79 this morning, so a little bit up again, and so coal is following the oil upwards. We had a forecast between 90 to 120 with an average of 110. Also revised down, so now a range of 70 to 95 with an average of 82.5, that's above 82, 83, around that level. And again, I think we are going to come a little bit back into this uptrend here, but the uptrend may now start to be a kind of a top, so it will come up to the old uptrend and then start to consolidating up there, unless oil breaks above 80. Don't forget this oil above 80. That's the key point, at least, that you have to take with you from here. There are some technical indicators saying that the coal market here is very, very low. I won't come into that, but this one is giving a lead or a hint that we may actually start seeing the trend moving back up again. So just to put it into, and you have this slide, hasn't been changed, revised in February, 70 to 100 for the average for the Q2, for the front quarter of the 3-month coal delivery, 85 in average, and for the more longer term, 82.5. And again, watch oil at 80. If that one comes in, you will see it going higher. The funny thing is, if you look at prices, issue 315 that reflects to the CEM review, this is the price for coal for delivery in Q2. This is the price for coal delivery in Q4, which is around 85. This is if you want to buy it in 21, 22, and 2023. The good thing is to say they are all above 80. So even if we saw a fall now, the long-term prices have more or less been hovering around this 80 level. This was back in October, where you saw that everybody was thinking it will go to the sky. So, petcoke. And again, petcoke, I really think this is the alternative fuels from the past, which is now becoming a kind of a more standardized market. There are also talks in the market. Yeah, that's fine. There are also talks in the market that this is actually now also will be some put on platforms, and maybe we'll even see more financial trading in the petcoke market, so it moves upwards, so to say. And again, this is just to say, petcoke is not the one running the refinery. It's, some have said this is really the end of the refinery, so this is the pricing. So some people said, well, what could happen if this and this happens to oil? It's more the competition with coal that makes the part of this. Again, this is the residual that is really left. Now, you've seen this before. Coal will normally always set the top. This is the price of coal. And this is in dollars, and this is the price for the two most traded elements. The high sulfur is the red one, and the low sulfur, the mid sulfur, is the blue one. And again, you'll see it's very, very seldom. It happens in a short time that petcoke gets more expensive, but then most of us will actually be switching in to using coke. I'm not going to go too much into the fundamentals. It's still China who sets the tone. This is what happens during last year. India, there was a lot of environmental maybe prohibiting the use of petcoke in India. All these problems were solved for the cement sector, but you can no longer trade petcoke in India. You can only buy it for consumption. Venezuela is out of the market, and again we had the trade war luring as well. Environmental legislation, it's always a risk, and of course we have to look out for these sulfur maximum size that are being introduced. So my basic for the background, so this is the last ones I will come through, is really India. We have a clear now, at least legalization for the use of petcoke, and for the cement industry, it's pretty clear. Cement and lime, we can use that. So India is coming back into the purchasing market. China fell away because when the trade war hit, China actually added a 25% penalty fee on US petcoke export. So that means that the market literally collapsed. Venezuela, sad story at the moment, nothing comes out there. Turkey is coming back after the massive devaluation. It's now recovering, so we see now some more, you can say, demand from Turkey coming in. And of course the trade war is still the open question here. Freight prices literally collapsed. They have been coming up now 20% over the last 2 weeks, but they literally collapsed, which meant that suddenly the producers could take more on their FOB prices. And increased use of alternative fuels, this is why it's super important that we are seeing here, will actually come in and make a little bit pressure on the long-term prices. We are looking very much into what is actually the discount. And this is a 10-year discount. So how much, if this is the price of coal based on 6,000 calorific value, if we convert the petcoke, how much cheaper is the petcoke then compared to buying the coal? And normally we have seen an average of about 40%, and then we can say we have some expensive petcoke, we can have cheap petcoke, and then we have it inside a kind of a neutral zone. This is if the demand is quite big, and this is if the supply is coming in on the top. At the moment we are seeing it coming into the cheap zone, but what you see is as soon as the market realizes there's a huge discount, there's a lot of petcoke being bought. The same when the price gets too expensive, people get away and they start buying the coal. So looking at the discount factor here is actually giving you a very good hint of when or when not to go into the petcoke market. At the moment we are seeing a percentage of about 47%, and this is a very nice, this is above average. So we can say petcoke is definitely on the cheaper range at the moment. If you go into the FOB, you have the freight, and on the freight part, the discount has been less. It has actually been very expensive with high freight rates. This is actually the fall in freight rates and then some fall in petcoke itself. But we are now creeping across the long-term trend, which is about 26, and we have it at 27. But here you can say, based on CFR, on ARA, it's more or less neutral. So what do we think? This is no reason to take it. So what do we think about the 6.5%? The 6.5% is more or less becoming the most traded part. That one, it has a trading that you see looking a little bit like, this is the 2016, looks like oil going up, coal going up, and we saw exactly the same thing happening on the petcoke market. Then it suddenly hit, this was October, and we saw literally a collapse down to around 55, 56 US dollars. I now see it trading in a kind of a, this was the trading range for last year, and we are now seeing a kind of a sideways, just like the coal, I'll be coming into that, but stuck at a kind of a 58, 68 level for the moment for the 6.5%.
Frank, you need to finish up.
Yeah, I'll do that. The 6.5 to the 4.5 will normally trade with a spread of roughly $10, which means that we are seeing the 4.5% roughly 10 US dollars more expensive than the 6.5, which comes into the forecast. Here we are, that's the one I want to talk. So again, we said the coal, we had an 85 average. For the 6.5%, where we used to have a 67 to 90 forecast, this has now been lowered to 55 to 80 with an average of $67. ARA, which is the price from the US Gulf to Europe, is based on 16. So on a 3-month level for the 6.5%, I say to Europe it's $83 and FOB 67. For the 4.5, I used to have a forecast like this, that is gone. Now it's 70 to 90 with an average of 75. And if we add the freight average for the year, I think we're going to see 91. So for the 6.5, 83. For the 4.5, 91. And I really like to see you when telling more. And of course, if you are not at the CemFuels, you don't have the Sem review, you look like this guy. But in Krakow in October, and I hope that Rob and the team will be one of our media partners there as well. We really want to go through and update on all these things as well. So I will say see you in Krakow. And if there's any questions, you can always contact me both here. I will be at the conference having some of the parts. And if any questions just now, please.